Hello, and thank you all for joining us today. My name is Rick Baker. I'm a client portfolio manager on the preferred income team based in Boston, Massachusetts. Joining me today is Joe Bezoyan, portfolio manager with over 27 years of experience. Joe's background includes fixed income, equity, and preferreds, and he's been with us at Manulife for over 10 years now. Joe and I will be highlighting preferred securities, an area that's getting a lot of attention as clients are looking for income in a low-yield environment. Our value proposition: preferreds offer favorable yields, low volatility, low defaults, low correlation, and less interest rate sensitivity. We hope you enjoy this overview, and we look forward to addressing your questions at the end. Joe, given the current economic and interest rate environment, how could preferred securities stand out from other asset classes over the medium to long term?
Yeah, thank you, Rick, and thank you, Manulife, for inviting us to speak today. So we expect the economic environment to continue to improve, particularly with the addition of several very effective vaccines. With an improving economic environment, we think there is potential for preferred yields to come down even lower as spreads tighten. The average yield spread of preferred securities versus the 10-year Treasury is still above the historical average yield spread, so there is that potential for more spread tightening. In addition, we expect spread tightening to be broader in nature, meaning that we expect more sectors to participate. For example, energy preferred securities are still trading below where they were trading prior to the COVID lockdowns, when the 10-year Treasury bond was 75 basis points higher. Other sectors like consumer cyclicals and telecom also have the potential for more spread tightening as the economy improves.
Joe, we've been saying for several years that we could be in a lower for longer interest rate environment. The 10-year U.S. Treasury this year has traded as low as 50 basis points and as high as 1.91%. Do you still believe we're in that lower for longer environment?
Yeah, that's a good question. So we do believe that we are still in a lower for longer interest rate environment. And we believe this because growth and inflation expectations are expected to be muted. Structurally, most Western economies are burdened with a rapidly increasing aging population. And in fact, the global 65 and over population will double in the next 30 years, 5 times faster than those under 65. And in the US, the over 65 population will increase more than 50% in the next 30 years, 6 times faster than those under 65. As this group enters their retirement years, this puts a tremendous burden on the ability of countries to grow, stifling GDP expansion. It also limits inflation since this group tends to spend less than the working age population, and consumption is 2/3 of our economy. In addition, interest rates around the world remain very low. In fact, over 17 trillion of debt globally has negative yields. This creates tremendous demand for positive yielding securities, which should also help to keep interest rates low.
Given the massive amount of negative yielding debt, how does this impact preferreds, and how does that compare to other areas of fixed income?
So an environment where interest rates stay low and credit spreads tighten is very good for preferred securities. Preferreds offer high yields, however, their average credit quality is investment grade, so our investors are able to achieve this yield without taking on a lot of credit risk. What also distinguishes preferreds from other areas of fixed income, particularly high yield bonds, is that many preferreds come with a fixed to floating rate coupon structure, whereby the first 5 or 10 years of the life of the security, the coupon is fixed, but then it floats. So if we're wrong in our lower for longer interest rate forecast, preferreds offer investors some protection from rising rates because of this structure.
So compared to other income generating investments, how do preferred securities fit into the income portfolios of Asian investors?
That's a good question. So we believe that preferreds should be part of an investor's portfolio, mainly because they offer attractive yields without taking on a lot of credit risk. You can see on the first slide the comparison of preferred yields versus other areas of fixed income. This slide shows that preferred yields are similar to high yield. However, the average credit quality of preferreds are BBB- or investment grade. High yield bonds, however, despite slightly higher yields, have an average credit rating of B+, which is well below investment grade. So you really are taking on less credit risk and getting a similar yield when you invest in preferred securities. And you can see from the next slide that default rates are very low for preferred securities. Historically, at only 0.33%, which makes sense given the average credit quality of preferreds is investment grade. Again, you see the comparison to high yield bonds, which have had a 30-year default rate of 4.06%. This year obviously has been a difficult year for many sectors of the economy. So there have been a few defaults in the preferred marketplace. But these defaults have been in the retail REIT space, and these companies had weak credit profiles going into the COVID lockdowns. We were very cautious on these companies simply because we weren't comfortable with their fundamentals. We are very proud of the fact that we have not experienced any defaults or even deferrals of dividends. Finally, the last reason why we believe preferred should be in an investor's portfolio is that preferreds have shown to be less interest rate sensitive over time. And this next slide shows that preferreds have performed well, even in rising rate environments.
Oh, thank you, Joe. So as we saw on the screen, 2013 is the most recent and most significant rise in rates that we've seen as the 10-year U.S. Treasury yield increased 1.26%. Over that period of time, U.S. bonds were down over 2%, while preferreds were up 2.66%. So this leads to my next question, Joe. Who issues preferred securities?
Sure. So the main issuers of preferred securities are financial service companies and utilities. Both sectors are very solid from a credit standpoint. Financial service company balance sheets are in the best shape in over 50 years, and bank capital levels are at all-time highs. And we're actually seeing evidence of the strength of bank balance sheets right now. Despite an extremely difficult operating environment for banks, these companies have been stable from a credit standpoint. In fact, most of them have maintained their common dividends. So we feel very good about their ability to pay their preferred dividends, and we're comfortable with their long-term fundamentals. Similarly, the U.S. utility industry has excellent fundamentals. Utilities are defensive investments anyway because they are regulated, so they have very stable earnings and cash flows. However, despite being considered defensive, utilities are expected to grow their earnings and cash flows at mid-single digits annually over the next several years, driven by investments in renewable energy. Now, this is impressive growth and compares favorably to many other sectors of the S&P 500. Importantly, my co-portfolio manager, Brad Lutz, and I both have extensive experience covering the utility sector. In addition, we can draw on several very experienced financial service analysts and portfolio managers to help us with our financial service sector investments.
So despite improvements in market sentiment, why are credit spreads still above that 10-year average? And when do you expect that situation to change?
Yeah, it's a good question. So the uncertainty of the economic environment because of the COVID lockdowns, we believe to be the main reason why preferred spreads remain above the 10-year average. The lockdowns that have occurred in the U.S. were devastating to U.S. GDP, with many sectors still struggling. We still have to get through this winter, but now with the announcement of several vaccines, we can see the light at the end of the tunnel. We believe that preferreds will start to discount the better economic environment, just like the equity market has been doing recently, which will result in credit spreads tightening further. In particular, sectors that have lagged, like energy and consumer cyclicals, we can still see significant spread tightening, as many of the names in those sectors are still trading below pre-COVID levels, despite the U.S. 10-year Treasury bond coming down 75 basis points.
So from a valuation perspective, how do longer-term trends such as rising levels of sovereign debt and bond buying programs affect preferred securities?
Yeah, so the supply of sovereign bonds has no doubt increased and will continue to increase. What happens to rates, though, depends on what the demand side will do. And so far, demand has easily kept up with the supply. And you're seeing this in the U.S. between the Fed, U.S. banks, and foreign investors soaking up that additional supply. So we don't think there's a strong reason to believe there's about to be a massive imbalance between supply and demand. The worldwide sovereign bond buying programs have forced investors to look away from the government market for income. This has also brought yields lower in corporate bonds, both investment grade and high yield. As I mentioned previously, currently over 17 trillion of debt worldwide has negative yields, creating demand for alternatives. Preferred securities provide a relatively high income alternative to these assets without giving up much in credit quality. So we would expect demand to grow as yields overall stay low for several years.
That's great, but that leads to my next question. What happens when all these governments start to unwind these balance sheets?
Yeah, so one of the future risks is the unwinding of government balance sheets. And this risk is present across all fixed income asset classes and likely could affect the equity market as well. While this risk exists, we believe that central banks will be mindful of the impact of yields increasing too fast on the financial and help to minimize that risk. That being said, there are various structures within the preferred market that will help us manage those risks. For example, securities that are fixed for a certain number of years and then float.
So which sectors in the preferred securities universe present the most attractive investment opportunities that you and Brad are seeing today?
It's another good question. So we think utility convertible preferreds are really attractive right now. As I mentioned earlier, utility fundamentals are very positive, and in fact, they are in the best shape in over 20 years. Again, this is driven by investments in renewables. So these companies are regulated, so they have very stable cash flows. And most of them have investment grade rated balance sheets. So we're able to get yields over 6% from a regulated industry that have investment grade rated balance sheets, where the average preferred yield is 5.5%. So that's why we like this space a lot. A quick example, we own a convertible preferred issued by a very high quality Michigan utility. It's a very well managed company with a strong track record of earnings growth. So they issued a 6.25% coupon mandatory convertible preferred just over a year ago, and it's still trading right around par value. So again, we own a high quality utility with an investment grade rated balance sheet, and we're able to get a 6.25% yield. That to us is really attractive.
And to build off why we favor utilities, utility equity valuations hit a 20-year low this year when compared to the S&P 500, and this defensive sector has done really well this year. Joe, what are your thoughts on energy? This sector was hit unusually hard on the sell-off in February and March.
Yeah. So we also like the energy midstream space quite a bit here. So midstream energy companies transport oil and gas on their pipelines. So they don't have any direct commodity price exposure. They generally have long-term contracts spanning 10 to 15 years with major oil and gas producers. So these businesses generate a lot of stable long-term cash flows. In the short term, they can sometimes trade with commodity prices. So as oil prices fell this year, many of these securities underperformed. As the market recognizes the stability of these companies' cash flows, we believe energy preferreds will outperform. And more recently, we have witnessed this as they have finally started to perform better. So here we're buying companies with valuable pipeline infrastructure that's very difficult to replace, that generates stable cash flows, and we're able to get yields over 6.5%, where again, the average preferred yield is 5.5%. So this is another space that we like a lot here.
So you favor utilities and energy. Are there any other areas of interest today?
Sure. Yeah, I guess the last area that I would like to highlight is what we call special situations. We have seen several preferreds that were issued as special dividends to common shareholders over the last few years. Common shareholders often don't want to hold these preferreds because it's not their area of expertise, and they want to hold common stocks. This can often put selling pressure on them initially. And these securities have been issued in the industrials, energy, and retail sectors. This selling pressure has created some really interesting opportunities. And these special situations offer a lot of yield from some very good companies. So again, this is another space that we like a lot as well.
Oh, great, thank you. So the preferred universe is dominated by U.S. companies and financials in particular. For example, financials are approximately 75% of the overall market. As such, investors may be worried about concentration risk. How would you address that?
Sure. So first of all, financial fundamentals are very strong. As I mentioned before, bank balance sheets are in the best shape in over 50 years. And that is why they've been able to withstand the current economic environment so well. With the exception of one major U.S. bank, all of the big banks have been able to maintain their common dividends. So we're very positive on the fundamentals of the financial services sector. Secondly, we have always had a positive bias to the utility sector. As mentioned previously, both Brad and I have a lot of experience covering that sector, and we know it really well. As I talked about earlier, we believe there are some great opportunities in that space. Again, we favor regulated utilities, mostly in the U.S. that have very stable cash flows. In fact, during the COVID lockdowns, utility earnings hardly were affected at all. And virtually all the U.S. utilities reiterated their earnings growth guidance that they gave prior to the COVID lockdowns. In addition, fundamentals are very strong owing to investments in renewables that may well increase in coming years.
Joe, do you think that we'll see an increase in preferred issuance across other markets, including Asia and other sectors going forward?
Yeah, we have seen companies in sectors other than financials and utilities come to the preferred market. In fact, companies from the retail sector, auto sector, industrials, tech, and healthcare now issue in the preferred marketplace. And we believe that trend will continue since preferreds are an attractive source of funds for companies. And so we expect them to continue to access that market. In terms of having a concentration in the US, the biggest preferred issuers outside of the US are the European banks. These preferreds are called COCOs, or contingent capital securities. Bank regulators in their respective countries have the ability to turn off their dividends or convert the securities to equity in the event the bank is facing financial pressure. So that's why we're cautious on European bank COCOs, since we don't believe we are compensated enough for the risk we take on by buying these securities. Again, European bank COCOs are a large part of the non-US preferred market. We have seen, though, a bit more issuance outside the US. We actually saw a European oil major come to the preferred market with a preferred this year. So we are seeing a bit more of this, which we think can continue, since, again, it is an attractive funding source for many international companies.
Great. Thank you, Joe. So in summary, preferred securities offer favorable yields relative to other income-producing securities, low volatility when compared to stocks, low defaults compared to high yield, low correlations to other popular asset classes, and less interest rate sensitivity. We appreciate your time to raise questions in the Q&A chat box. Joe, let's take a look at some of the questions that we've been receiving.
Sure.
So first question up, you've mentioned financials and utilities. What other sectors make up the preferred universe?
Sure. Consumer cyclicals and telecom also are part of the preferred universe. And again, as I said, there are some special situations out there. So we have seen some issuance in the retail sector and also in the industrial sector. But telecom and some consumer cyclicals are the two other major parts of the or sectors within the preferred marketplace.
Excellent. Next question up for you, Joe. In terms of return breakdown, would you expect more will be coming from price given the spreads, or expects to tightening further?
So we, as I mentioned before, we do expect some spread tightening. Again, as the economy improves and sectors that have not participated in the spread tightening so far start to participate going into next year. So we do think that we can get some price appreciation from that spread tightening. So on top of that, you're going to be able to get your coupon as well. So our return expectations for 2021 are coupon plus a little bit more.
Excellent. Next question. How big is the preferred market? You want me to tackle that one, Joe?
Sure, yeah.
So I guess to put that in perspective, we're often compared to the high yield market, and the U.S. high yield market is approximately $1.5 trillion today. Unfortunately, there is no true benchmark that includes all aspects of the preferred securities market. So on a semi-annual basis, we analyze different areas of preferreds. So today, just under $1 trillion, that's global, so $1 trillion. This includes junior subordinated bonds, preferred stock, baby bonds, European COCOs, convertible preferreds, and REIT preferreds. And we'll be updating these figures at the beginning of January, but as the markets have recovered significantly since we last took a look, I think we'd expect that to be above $1 trillion today. Next question for you, Joe. Based on your macroeconomic forecast assumption, do you expect the credit quality and default rates of preferred securities, can they be maintained going into 2021, and why?
Yeah, I do. Again, we do expect the economy to start to improve as we do get these vaccines rolled out. So we have not seen much in the way of default so far. Again, it's really been kind of focused on the retail REIT space, and I think at this point, the weak players in that market have already kind of gone away, frankly. And so I think going forward, the defaults will be very minimal at this point. Particularly, I think with an improvement in the energy outlook going into next year, that's a space that been kind of on the high yield side anyway, had some issues in 2020 where you did have some defaults. But I think again, as the commodity price outlook improves going into 2021, that I think that default rate, that low default rate number, should stay where it is. And so again, we're not expecting a lot of defaults going into 2021.
Yeah, great. Thank you, Joe. It's a big difference when you compare it to the U.S. high yield market and the global high yield market. It's great to hear. Next question for you, Joe. What are the investment opportunities of consumer cyclicals and telecom?
Yeah, so we've actually seen some good opportunities in both spaces, both sectors. So some of the auto companies have been issuing preferreds, and both auto manufacturers have actually improved quite a bit over the last several years. We have owned some of those securities in the past, and so we think those are pretty good preferred securities and pretty good opportunities here. And in the telecom space, we're seeing some of the companies that are benefiting from the work from home environment, and those companies actually their fundamentals have actually improved quite a bit during this period of time. So we're seeing some good opportunities there as well.
Excellent. Next question: will the outlook for preferreds change under a Biden administration?
Yeah, I don't think so. And think about who the big issuers of preferreds are. They're financial services companies and utilities. Financial services companies are regulated so heavily right now, so we're not expecting regulation to increase under a Biden administration. And again, their balance sheets are in such great shape right now, with bank capital levels are at all-time highs. So we don't think that the Biden administration will do much to affect the financial services sector. On the utility side, actually, we think that the Biden administration can actually improve the fundamentals there, given the fact that they might really push for more renewable investments, which would be positive for the utility sector. So, and I don't really think it's going to change the macro environment either. So we still think we're in that lower for longer interest rate environment. So given the fact that utilities and financial services companies are the big issuers, we expect their fundamentals to be solid going forward, and interest rates remain fairly low. So we don't really expect much of a change at all with this new administration.
Excellent. Looks like we've got one more question here. Is there an ESG angle to preferred investments?
Yeah, no, I think with the utility sector, as I mentioned, they're such big players in the renewable space now, and they're really leading the transition to renewables in the U.S. And obviously, that's obviously very good from an ESG standpoint. So that is the real, I think, big angle, particularly for our portfolios, because we have such a focus and bias towards utilities that our portfolios really do have that ESG angle to them.
Excellent. Well, finally, please share your feedback for this session using the polling questions. That wraps up this session. Thank you all very much for joining us today. As we are in this lower for longer environment, we hope you consider preferred securities as a way to increase your clients' income. Thank you all very much.